right. Our next guest believes we are closing in on an inflection point in the market. Joe LaVorgna was the chief economist at the White House National Economic Council. He's now chief economist at SMBC Nikko Securities America. Joe, great to see you. You think the market can't rally much longer?
I'm still in the recession camp, and I'm listening to all the comments, very interesting, about the 10-year yield. And we know we discount the equity market, which is a long-duration instrument, by 10 years. But investors right now can earn 5.5% in Treasury bills with no duration risk, no liquidity risk, nothing. That yield curve is still extraordinarily inverted. And to me, that's why the soft landing ultimately doesn't make sense. I do believe in the wisdom of crowds, and the yield curve does have an unblemished forecasting record. The issue always, Melissa, is the timing. And the timing with these things is always very difficult. But as long as that short rate is yielding well above 5%, my guess is over time, you're going to suck more and more liquidity out of the market. That will be bad for risk taking. And that means lower stock prices and much wider credit spreads.
Hey, Joe, the dollar's had this move. I mean, year over year, it's down pretty significantly, but it's kind of dropped off in the last month or so. How are you thinking about the dollar in this framework, and what does it mean for U.S. corporate earnings? Because, again, we just mentioned that GDP print, and we talk about corporate earnings where I think a lot of folks were thinking that S&P would be, $200 this year, and we're still consensus solidly above that. And I'm wondering how much do you think the dollar is playing into that?
The dollar is, overseas earnings, my understanding is about 40% or thereabouts of the S&P. I mean, feel free to jump in and correct me if I'm wrong. You highlighted China being soft. Their inflation is weakening quite dramatically. If we've got disinflation coming out of China, that ultimately should come back into the U.S., even though recently we've seen agricultural and energy prices rise. I don't think the dollar is a major factor for the Fed and a major factor for the equity market. It seems to me that monetary policy still is the predominant straw that stirs the drink. And the Fed is almost done hiking, hopefully. But with rates high and the Fed undertaking QT, I think that ultimately is more important. And when they stop, it'll be a function really of the labor market, less so the dollar, right? The labor market has to loosen. Unemployment has to rise. Wage growth needs to slow. That's what Powell reiterated again yesterday. And the only way that happens, Dan, is if the economy goes into a recession, which ironically the Fed staff apparently now is not forecasting a recession. So I don't think the dollar really is that central here, unless it really was to collapse. And that to me is unlikely because other than the yen, I don't see the euro, which the Eurozone arguably is already in recession. That's not going to supplant the dollar at the moment.
Why are you still in the recession camp, Joe? And what's your time frame for this call?
I'm still in the recession camp for two reasons, Melissa. Number one, if you look at the index leading indicators and the yield curve, we're closer to the midpoint to the sort of the back half of like the longest leads we've got. Rebecca talked about the housing market not behaving normally like it does because people have locked in low rates. They've also done that, by the way, on auto loans. So again, these leads or these lags from monetary policy are long and variable. Until some of these forward-looking indicators reverse, I still think you have to be much more worried about recession. Maybe the probability of recession's fallen a little bit, and maybe you get some weird inverse operation twist scenario where somehow the front end could rally a bit on modest Fed easing and the back end sells off. But the only way historically the yield curve has ever normalized is through Fed easing. And given how inverted it is, the Fed has to ease a lot, which implicitly means if it's going to ease a lot, there must be a recession.